You did the top-down analysis properly. Weekly, daily, 4-hour, 1-hour, 15-minute. You mark your market structure on all of them, your supply and demand on all of them, your liquidity and your fair value gaps on all of them, because that's what you were told top-down analysis meant. And when you finished, you looked at that and you were less certain about the trade than you had been before you started. That isn't a sign you analyzed it badly. It's the predictable result of applying every concept you know to every time frame you can open. And it does something worse than simply confusing you. A chart with 40 things marked on it will always contain a justification for whatever you already wanted to do. If you wanted to be long, there's a demand zone somewhere in that mess to point at. If you wanted to be short, there's a fair value gap that supports it. The analysis stops being a filter and quietly becomes a permission slip, which is the exact opposite of the job it was supposed to do. So over the next 15 minutes or so, we're going to fix that. And we're going to fix it by removing things rather than adding them. You'll come away with a fixed job for each of the 5 time frames, one job each, and an explicit list of what you are not allowed to draw on them. You'll understand why higher time frames carry more weight, which almost nobody explains properly, and why that reason means a fresh 4-hour zone will often beat a worn-out weekly one. And you'll get a rule for the situation that causes more hesitation than anything else in multi-time frame trading, which is what to do when the 4-hour says one thing and the 1-hour says the opposite. That situation isn't a flaw in your reading. It's guaranteed to happen. It happens for a specific structural reason, and once you understand the reason, it becomes one of the more useful things your chart can show you. We'll build to that properly, because it deserves more than a sentence.
Quick foundation before we get going. And if you already know this, the chapters are in the description, and I'd genuinely rather you skipped than sat through it. Top-down analysis means starting on a high time frame and working downward. The weekly and daily tell you where price is in the broader picture. The 4-hour tells you what the market is currently doing. The 1-hour is where the trade gets taken. The 15 and 5-minute exist for confirmation and nothing else. That much is standard, and almost everyone knows it. The concept was never the problem. What nobody specifies is what you should stop doing on each of those charts. And that omission is where the mess comes from. Before any of the practical steps, we should deal with the assumption underneath all of this, because it usually goes unexamined. Everybody accepts that a weekly level matters more than a 5-minute level. Ask why, and the answer you'll normally get is that the higher time frame is stronger, or that it holds more weight, or that more traders are watching it. None of those are explanations. They're restatements of the thing we were trying to explain, delivered confidently enough that most people don't notice. To get at what's really going on, it helps to think about the practical problem faced by anyone trying to fill a genuinely large order. Suppose an institution wants a position that represents a meaningful share of what actually trades in that pair in a day. They can't simply send that order into the market, because if they did, they would consume every available offer and push the price up against themselves with each additional unit. The first part of the order would fill at a good price, and the last part would fill at a terrible one, and the average would be far worse than where they started. So they don't do that. They work the order over time, leaving resting interest at prices they're willing to transact at, and they let the market come to them rather than chasing it. The consequence of that is unfinished business, interest that wanted filling and never got filled, sitting at a specific band of prices. Now the time frame part, and the variable that actually matters is time. A 5-minute level has existed for 25 minutes. Whatever interest has gathered around it, it has had 25 minutes to gather. A weekly level might have been in place for 8 months. Every participant who wanted to transact around that price and didn't get filled has had 8 months to leave orders sitting there. Every trader who got hurt at that level has had 8 months to place a break-even order. Every algorithm that tracks prior extremes has had 8 months to identify it. Same mechanism, radically different quantity of resting interest. The weekly level isn't stronger because the candles are bigger or because it's somehow more real. It's stronger because more time has passed, so more has accumulated. And once you see it that way, A practical rule falls out of it that the usual framing never produces. If the reason a level matters is accumulated orders, then a level where those orders have already been consumed is no longer a level. Price has traded through it twice. The resting interest got filled. The business is done. It will look absolutely identical on your chart. Same horizontal line, same color, same time frame label. And it is functionally empty, which means freshness beats time frame. A clean, untouched 4-hour zone will regularly outperform a weekly level that price has already chewed through. That single idea will remove more bad trades from your month than any new pattern you could learn. And it comes directly from understanding the mechanism rather than memorizing the hierarchy. The second thing we need to establish is the one that causes the most hesitation in practice. Your 4-hour is bullish. Your 1-hour is bearish. You sit there trying to work out which of them is telling the truth, and the honest answer is that they both are, and that this was always going to happen. Take this 4-hour uptrend. Impulse up, correction down. Impulse up, correction down. Perfectly normal. Now take this correction here, the one in the middle, and drop into it on the 1-hour. Lower highs, lower lows. A break of structure to the downside. That is a downtrend by any definition you want to use. And a 1-hour trader looking at that in isolation would be entirely correct to trade it short and would very likely make money doing so. So the 4-hour correction and the 1-hour downtrend are not two different opinions about the market. They are the same price action described at two different resolutions, which means the disagreement between your time frames isn't a defect in your analysis, and it isn't something you can eliminate by being more careful. It's structurally guaranteed. It will occur every single time the higher time frame pulls back, without exception, forever. Once that lands, the question you've been asking turns out to be the wrong one. You were asking which time frame to believe. The question that actually has an answer is whether this lower time frame move is a correction inside the higher time frame trend or the beginning of that higher time frame trend failing. And you cannot know that yet. Nobody can. What you can do right now, before anything happens, is write down precisely what would distinguish the two. We'll come back to that once we've been through the time frames themselves, because the routine has to be in place first. 5 charts, 1 job each, and a governing rule that overrides everything else. If a marking wouldn't change what you do, it doesn't go on the chart. Not because it's wrong, but because every unnecessary mark is another potential justification for a trade you shouldn't take. Weekly, levels, and nothing else. No structure, no zones, no liquidity, no fair value gaps. 2 or 3 horizontal levels nearest to current price, and then you close the chart. When you're choosing which levels deserve the ink, run the left side check on each one. You're looking for a few specific qualities, and they all trace back to the same order accumulation idea we went through earlier. You want levels that have acted as both support and resistance at different times, because a price that has served both roles has had participants transacting on both sides of it and has accumulated interest from both directions. You want levels that price left in a hurry, because a violent departure indicates the area was genuinely contested rather than casually passed through. You want multiple touches, since each one represents another round of business. You want turning points, the places where the market actually changed its mind about direction. And you want relative freshness, for the reason we spent time on. An area that's been picked apart repeatedly has had its inventory cleared out. When you draw them, position the line to catch the greatest number of reactions, rather than to be technically perfect about any single one. Whether you draw from wicks or bodies genuinely does not matter, and traders lose an unreasonable amount of time on that question. Treat every level as a band rather than a line, because that's how price treats it. Daily, the same job in a different color. The daily chart does not get new concepts. It gets the same job at finer resolution. You adjust the weekly levels slightly, now that you can see the candles more clearly, and you add any daily levels that meet the same criteria. Use a different color, and be disciplined about it. Later on, when you're down on the 1 hour with price approaching something, you need to know instantly whether you're looking at 8 months of accumulated interest or 8 days of it. Those two situations call for different amounts of respect, and you won't remember which is which by then.
4 hour, direction and zones.
The story time frame. This is where the smart money concepts finally come in. And this is the chart that tells you where you are in the narrative. Mark the breaks of structure and identify the protected low. And it's worth being precise about what that means because the term gets used loosely. The protected low is the low that produced the most recent break of structure to the upside. It matters more than the other lows because it's the origin of the current leg, the point where buyers stepped in with enough force to take out a previous high. While price stays above it, the thing that caused this move is still intact. If price closes below it, whatever produced that leg has failed, and you're no longer in the same market you were analyzing. Then mark the zone the current leg originated from, and assess its quality rather than just accepting it. 3 things make a zone worth trading: whether it left inefficiency behind, visible gaps between the candle wicks, which tell you price moved so quickly that one side simply wasn't there to trade against, whether the move out of it broke structure, which confirms the participants who acted there had enough size to change the market's direction rather than just nudging it, and the push distance, how far price actually traveled away from the zone. Because a zone that produced a large move demonstrated more conviction than one that produced a small one. While you're on this chart, also read the momentum asymmetry, a habit worth building and one very few traders bother with. Compare how long the impulse took against how long the pullback has taken. If price covered that ground in 12 hours and has spent the last 3 days grinding slowly back into the zone, the sellers doing the pulling back are visibly weaker than the buyers who created the impulse, and the trend is in good health. If the pullback is moving faster than the impulse did, something has changed, and you should be considerably more careful about assuming continuation. 1 hour, the trade. Structure, entry, stop, target. This is where business actually gets done, and it's the only chart where you're allowed to be looking for a position. 15 and 5 minute, confirmation only after arrival. These two charts have a very narrow purpose, and it is easy to abuse them. You do not open them to look for setups. You open them when price has already arrived somewhere that you decided in advance was important. And you open them to answer one specific question. Is the reaction I expected at this level actually appearing? That might be a break of the short-term structure in your direction, a change of character on the lower time frame, or a sweep of the low followed by an immediate reclaim. Any other use of a 5-minute chart is browsing. And browsing on a 5-minute chart is simply generating reasons to click. If price hasn't reached your level yet, that chart should be closed. With the routine in place, we can return to the conflict problem properly. When your 4-hour and your 1-hour disagree, you do not pick a side. You write both branches down, and you wait for the market to choose one. Look at what we've got. The 4-hour is still bullish, protected low intact. Price has pulled back into 4-hour demand, and that demand happens to sit on a weekly level, so there's genuine reason for buyers to be interested there. But the 1-hour has broken its low and printed a change of character, which means sellers have taken control of the smaller structure. The instinct is to force a call. And the way that usually goes is that a trader looks at whichever time frame agrees with the position they already fancied and treats that as the answer. The chart is crowded enough to support either reading, which is exactly the problem we opened the video with. The alternative is to write the plan before anything happens, in 2 branches. If price breaks and closes below this demand zone, the 4-hour protected low goes with it. At that point, both time frames are bearish. The higher time frame question has been answered, and I'll be looking for shorts on a pullback into supply. If instead, price rejects this zone and reclaims the 1-hour high, the change of character has failed. Both time frames are bullish again, and I'll be looking for longs toward the daily level above. And until one of those two things happens, there is no trade. Not a small position, not a scalp while waiting, not a partial, nothing. The value in this isn't complicated, but it is easy to underestimate. You are deciding, while you're calm and have no money at risk, what would change your mind. That decision is close to impossible to make honestly once you're in a position, because at that point, every piece of evidence gets weighed according to whether it supports what you've already done. Writing the branches in advance is the only reliable way I know of to keep the analysis and the position separate. 3 things to take away. Each time frame gets one job. Weekly and daily give you levels. The 4-hour gives you the story. The 1-hour gives you the trade. And the lower 2 confirm after arrival. Nothing else goes on those charts. Higher time frames carry more weight because orders have had longer to accumulate there, not because they're inherently stronger, which is why a fresh 4-hour zone will often beat a weekly level that's already been worked through. And when your time frames disagree, that's information rather than a problem. Write both branches and let the market pick one.